Platinum sits at the crossroads of industry and investment. When every metal has a story, platinum quietly powers catalytic converters, hydrogen catalysts, and specialty chemicals. Right now, a confluence of disrupted supply, steady factory demand, and policy shifts is reshaping markets. Traders watch the price hovering around the $1,000 per ounce level, drawing new participants and hedges. In a world chasing cleaner energy and stronger balance sheets, platinum has a voice that cannot be ignored, even as other metals grab headlines. Investors seek clarity from supply dynamics, recycling, and industrial usage, looking for resilience amid volatility and policy shifts. Platinum is a dense, corrosion-resistant metal valued for chemical catalysts, electrical contacts, and jewelry. In vehicles, platinum is a critical ingredient in catalytic converters that reduce exhaust emissions, especially in diesel and hybrid engines. Demand flows from automakers to refiners as catalysts scale with car sales and regulatory tightening. Price action now reflects a tug-of-war between supply constraints from major producers and recovering factory output worldwide. Platinum responds less to safe haven flows and more to industrial demand and technology cycles. Investors watch mine supply, recycling rates, and alternative catalysts as the metal toggles between scarcity and opportunity. Platinum emerged as a driver of industry decades ago, recognized for durable catalysts and jewelry play, but its market revolves around a few giant miners. South Africa dominates output, followed by Russia and North America through recycling streams. The metal's price has swung with auto demand, refinery margins, and mine disruptions from strikes and power outages. The 2008 financial crisis showed platinum's dual nature as both industrial input and speculative asset, while the 2020 pandemic stressed car sales and recycling. Today, producers balance capex with curtailments, while investors compare platinum to palladium as a barometer of manufacturing health and demand. Current market impact. Platinum's price has moved with industrial sentiment and mining news. After months of range trading near $970 to $1,100 per ounce, the metal found footing on signs of revival in auto shipments and strengthening recycling. Exchange-traded products saw cautious inflows as funds sought diversification beyond traditional safe assets, with PPLT and other exposure gaining modestly in the last quarter. Analysts cite resilient demand in catalysts and hydrogen segments, while supply discipline from South Africa and Russia keeps inventories lean. The net effect? Platinum remains a factory floor metal with a price that reflects engine cycles rather than just fear and flight to safety. Who is affected? Platinum markets ripple through car makers, refiners, and investors who ride catalysts and coin-based bets. Automakers face tighter emissions rules and tighter budgets, driving demand for efficient catalysts, while after-sales relies on high-quality parts. Key producers of catalysts such as Umicore, JM, and Heraeus track platinum loadings to meet diesel and hybrid mandates. Recycling streams from jewelry and industrial components provide a supplement to mine supply, while ETFs and futures funds chase diversification beyond traditional safe assets. Investors include central banks hedging inflation, family offices seeking real assets, and miners balancing capex with dividend policies in a volatile cycle. Geopolitical and macro factors shape platinum the way weather shapes crops. South Africa, the main producer, faces labor unrest, energy constraints, and policy debates that can throttle mine output by double digits in a single quarter. Russia remains a modest but strategic supplier of PGMs, subject to sanctions and shipping routes that complicate logistics. Global auto demand linked to emissions targets drives core consumption, while China's industrial resilience adds a floor to end use. Inflation trends, higher interest rates, and currency moves affect mining financing and investor appetite. The hydrogen economy promises new catalysts, widening platinum's optionality beyond autos today. Smart money focuses on supply discipline and long-term demand, not just headlines. Major funds have begun to skew allocations toward industrial metals, using platinum to diversify away from energy bets. Analysts note rising net long positions in platinum futures on major exchanges and inflows into physical products like the SPDR, Platinum Shares family, and other regional ETFs. Industrial buyers secure forward cargoes, while hedge funds position for a potential catalyst shift as electric vehicle policy tightens. In consumer cycles, jewelry demand remains a barometer, but the real test is how quickly catalysts scale in factories worldwide, globally, everywhere today. Bear case and risks. Platinum faces several downside catalysts that could erase recent gains. If global auto sales stall or emissions rules soften, platinum demand for catalysts could weaken, pushing prices back toward the 800s. Recycling rates might disappoint, while new platinum-free catalysts emerge in some markets, widening substitution. Rising supply from primary mines and improved efficiency in diesel engines could further tilt supply, creating inventories that outpace demand. Geopolitical tensions might ease, lowering risk premiums and drawing capital elsewhere. Hydrogen and fuel cell catalysts offer optionality but also execution risk, as scaling industrial adoption takes time and capital. How retail investors can respond. Start with education and risk limits before adding platinum exposure. Consider core options like physical platinum bullion or diversified funds that track platinum supply and demand. Set clear price bands and position sizes to avoid volatility spikes. Use stop-loss planning and quarterly reviews as industrial demand and mine news move. Prices. Diversification across assets, not just metals, helps weather policy shifts. For newcomers, begin with a modest allocation within a broader commodities sleeve and learn how catalysts influence industrial demand, recycling, and end use. Remember that platinum's strength comes from tangible industrial use beneath the surface. Outlook and call to action. Platinum could continue to trade in a broadened range as the auto industry modernizes and hydrogen fuel cell research accelerates. If supply constraints ease, prices may drift lower, but if emissions regimes tighten and recycling expands, prices could test higher. The catalysts market remains a dynamic balance between industrial need and substitution risk, with recycling a crucial swing factor. For long-term investors, platinum offers a potential inflation hedge tied to world usage and policy shifts. Stay informed, manage risk, and watch regulatory cycles for decisive moves. If you found this valuable, subscribe to the Commodity Brief for weekly insights on alternative assets and commodities.